How do market makers use delta hedging? Have you ever wondered how market makers navigate the complex world of options trading? One of their key strategies is delta hedging, and today we will break it down. Delta hedging is essential for market makers to manage risk effectively. It helps them balance their exposure in options positions by offsetting it with positions in the underlying asset. This balancing act allows them to maintain a neutral stance in the market while minimizing directional risk. First, let's talk about delta. Delta is a measure that indicates how much an options price will change when the price of the underlying asset changes. For instance, if a call option has a delta of 0.5, a $1 increase in the stock price would theoretically increase the options price by 50 cents. Now, how does delta hedging work in practice? When a market maker sells an option, they take on the risk that the option's value may change. To manage this risk, they engage in delta hedging. This involves selling the option and simultaneously buying a certain number of shares of the underlying asset. The number of shares purchased corresponds to the delta of the option. The goal is to create a delta-neutral position where the overall delta of the portfolio is close to zero. Let's consider an example. Imagine a market maker sells a call option with a delta of 0.6. To hedge this position, they would buy 60% of the number of shares that the option represents. If the stock price rises, the delta of the option may increase to 0.65. To maintain a neutral position, the market maker would need to buy additional shares to offset this increased delta. Delta hedging not only helps market makers avoid significant losses due to price movements but also contributes to market efficiency. By providing liquidity, they help stabilize prices in the options market. However, this strategy does come with challenges. Continuous monitoring and rebalancing are necessary, which can incur costs. Additionally, changes in volatility or other factors can affect how well the hedge performs. Interestingly, delta hedging can also be applied using futures contracts. Futures contracts serve as a proxy for the underlying asset, allowing market makers to hedge options positions more efficiently. This is especially useful when the underlying asset is not easily accessible or when futures contracts offer better liquidity. In the realm of stock trading and options, delta hedging is a vital tool for managing risk and maintaining stability in the market. It allows market makers to provide consistent liquidity while minimizing their exposure to market fluctuations. Understanding how market makers utilize delta hedging can give you a clearer picture of the dynamics at play in options trading.